from SBL exam kit. The case goes like this. The board of YGT discussed its need for timely risk information. The consensus of the meeting was that risk consultants should be engaged to review the risk facing the company. One director, Ras Datta, said that she felt that this would be a waste of money as the company needed to concentrate its resources on improving organizational efficiency rather than on gathering risk information. She said that many risks didn't change much and hardly ever materialized, so can mostly be ignored. The rest of the board, however, believed that a number of risks had recently emerged, while others others had become less important, and so the board wanted a current assessment as it believed previous assessments might now be outdated. The team of risk consultants completed the risk audit. They identified and assessed 6 potential risks A to F, and the following information was discussed when the findings were presented to YGT board. Okay, we are given about the various risks. Risk A. Risk A was assessed as unlikely and low impact, while risk B was assessed as highly likely to occur and with a high impact. The activities giving rise to both A and B, however, are seen as marginal in that while the activities do have value and are capable of making good returns, neither is strategically vital. Risk C was assessed as low probability but with a high potential impact and also arises from an activity that must not be discontinued, although alternative arrangements for bearing the risks are possible. The activity giving rise to risk C was recently introduced by YGT as as a result of new product launch. Risk D was assessed as highly likely but with a low potential impact and arose as a result of a recent change in legislation. It cannot be insured against nor can it be outsourced. It is strategically important that the company continues to engage in the activity that gives rise to risk D, although not necessarily at the same level as is currently the case. In addition, risk E and F were identified. Risk E was an environmental risk and risk F was classed as a reputation risk. The risk consultants said that risk E and F could be related risks. In the formal feedback to the board of YGT, the consultant said that the company had to develop a culture of risk awareness and this should permeate all levels of the company. Required criticize Raj Datta's beliefs about the need for risk assessment, explain why risks are dynamic and therefore need to be assessed regularly. Using the TARA framework, select and explain the appropriate strategy for managing each risk. Explain what related risks and describe how risk E and F might be positively correlated. Okay. Um, from the content what we have read through just now, here there is an opinion that risk assessment is not needed. Okay, the board of YGT discussed its need for timely risk information. So, assessment about what are the risks which are present. Okay, to evaluate that, to assess that, all those things usually are taken up. But there is an opinion from one director, Raj Datta. She feels that this would be a waste of money as the company needed to concentrate its resources on improving the efficiency rather than on gathering risk information. So here um, there is an opinion which is very dominantly presented by the director, saying that the resources should not be spent on assessing the risk, gathering information, but it should be spent on some other events that where the efficiency of the organization can be improved. In this note, in this context, we have the first question asked. The first question talks about criticize Raj Datta's beliefs. So the question directly is addressed here, criticize. So which means that you have to take the opinion that whatever Raj Datta has mentioned is not correct, or it is, I mean, what are the um, issues which would arise if the risk assessment is not taken up. In that tone you have to start your arguments. So criticize Raj Datta's beliefs about the need for risk assessment, explain why risks are dynamic and therefore need to be assessed regularly. So first we need to understand whether they are whether um, risk assessment is needed or not is first. Unless and until we are convinced, we will not be able to. So in the examination it is not just one line or a one statement which you make and then say that no, risk assessment is needed. But why is it needed? Because it's an 8 marks question here. So why is it needed? Unless and until we are convinced, we will not be able to present it. Okay, her point is that the why waste resources on assessing the risk, because she has some point which she says that she said that many risks didn't change much and hardly ever materialized, and so can mostly be ignored. The rest of the board, however, believed that a number of risks had recently emerged and the others had become less important. So that is her argument. Writing an answer worth 8 marks um, is the issue here. Speak on the mic and tell me, do you think risk assessment has to be taken up? So no matter what we believe, also the question directly starts as um, criticize. Criticize about what this director Raj Datta feels. So critical analysis. You can also use chat box to put your points. Only 5 are there. Okay, no problem. Any one of you? At least one point something. Am I audible? Am I audible? Okay, fine. So point number one is she feels that this is not needed. Now we are not allowed to go with her opinion, because the question has directly started. I mean, is given as criticize her beliefs. So a critical analysis has to be taken up. So She has her own arguments. What are her arguments? Her arguments are that she felt that this would be a waste of money. She said that many risks didn't change much. Okay. And another point, what she adds here is hardly ever materialized and so can mostly be ignored. That's her point. She said that many risks didn't change much and hardly ever materialized, and so can mostly be ignored. The rest of the board, however, believed that a number of risks had recently emerged. So now, if we are criticizing her beliefs and then um, counter argument is presented, then we also have to look into what is what are the other members of the board, uh, what is their opinion. Okay. The rest of the board, however, believed that a number of risks had recently emerged, while others had become less important, and so the board wanted a current assessment as it believed previous assessments might now be outdated. So that there itself we have the answer. The answer is didn't change much. But then there was some change. It is not that it was completely static. She says that there was not much change, but it is not that absolutely there was no change. That is not the situation. So we can take information from that particular first belief that they didn't change much. So we can talk about that. It was not static, it was changing. There was some change. There were uh, the very meaning and definition of risk. How did we started understanding what is the term risk? Risk is the variation in what is expected. So if there are variations in the expected um, values, then we call that as risk. And these variations, when they are associated with the probabilities, we have called it as risk. Otherwise, it was called as uncertainty. Done. So here, if the risk didn't change, so when there is a risk planning taken up, when the risks which when the variations which would arise are assessed, so there was some kind of planning taken up for those variations which would happen in the future. Now, when there was planning taken up, here her argument is whatever were the risks which were anticipated. How are risks anticipated? There are events which would happen in the future anticipated. The basis, past performance, past events are taken into consideration, and what are expected to repeat in future are also noted down, and then planning is taken up. So the risks are identified from the events which happened, and if those events happen, what are the consequences of those events are noted down, and the probability of those events or those consequences are also noted down, and the product of the consequence into the likelihood or the probability is called as the risk. So accordingly, planning can be taken up if there is a risk present in the future, in the situation, in the business, in that particular um, environment, in for that particular industry, for that particular business. If it is identified that risk is present, then planning can be taken up. So but her argument is that since already these were identified and not much change happened, not much change happened is her argument. But yes, it was not that there was no change happened, not much change happened, didn't change much, but there was, yes, there was some change. And then she says that hardly ever materialized is her argument. But the board says that the rest of the members of the board say that some of them have become outdated, while uh, a new set of or recently emerged risks are identified. So some of them are identified as recent ones. So based on this, we have to build up an answer arguing about how uh, Raj Datta's views are not correct in this scenario. It is not applicable in this scenario because the scenario is not a static. This business is not static, or it is not that there are no changes which are happening there in that particular business. So that is not valid here because of what she has presented and what other information which we can gather from the views of the other members of the board. We can build up an answer and then talk about um, criticizing her view. Is that point clear? Is that clear? Okay. After that, then the team of risk consultants completed the risk audit. Okay. They have identified and assessed six potential risks, A to F. So we have um, we provided with those details. We are provided with those details about what are these risks. Okay. So risk A, risk B. Here it says that risk A, and we'll read them once again. But then the question says, A bit, criticize Raj Datta's beliefs about the need for risk assessment. Explain why risks are dynamic. Why are they dynamic? Because of the change which happens in the business, and yes, it is dynamic, it is not static. So that is what we have to argue here. It is dynamic because there are changes happening. Whatever was planned or whatever was assessed, what risks were assessed, some of them have become outdated, some new risks have emerged. Then there is a change which is happening. So, on that note, we see that it is a dynamic environment. It is the risk assessment is dynamic because they have to keep themselves updated with what are the changes which are happening in the industry, in the business, what is happening among the competitors, the peers, what are the changes in the economy. All those aspects have to be noted down carefully and identify what are the new risks which are arising. So on that note, it is dynamic. Okay. The same planning what happened, what took place some time back is not applicable because new risks are have emerged. So to understand that, there should be a careful analysis about pest analysis, pestle analysis. So the various aspects of the economy, the political scenario, the industry, the competition, all those things have to be understood to plan for the new ones which have emerged. So on that note, it is dynamic. So use that term, why explain why risks are dynamic. Okay, and therefore needed to be assessed regularly. So present your point accordingly. After that, the second bit talks about using the Tara framework. Select and explain appropriate strategy for managing um, A, B, C, and D. Justify your selection in each case. And then for the last two, E and F, explain what related risks and are, and describe how this E and F might be positively correlated. We've learned about Tara's framework. So let's just quickly go through what is this framework. Okay. Um, we've done this one. See, the probability or likelihood of the events happening is vertically presented. It is low, high, and the consequence or the impact of those events and the consequence of that is presented horizontally, low and high. So, depending on that, the strategy has to be adopted either to accept, reduce, avoid, or transfer. So, we've learned this one. Focusing on this, let's answer the case. Okay. Risk A was assessed as unlikely and low impact, while risk B was assessed as highly likely to occur and with a high impact. The activities giving rise to both A and B, however, are seen as marginal in that while the activities do have value and are capable of making good returns, neither is strategically vital. So, these two, risks A and B, are clubbed together, and then risk A was assessed as unlikely and low impact. If that is the case, what should be the response? Risk B was assessed as highly likely to occur and with a high impact. The activities giving rise to both A and B, however, are seen as marginal in that A, the activities do not have value and are capable of making good returns, neither is strategically vital. Tell me what should be for A, risk A. What should be the response? Should it be accept, reduce, avoid, or transfer? Quickly, because this is very simple. So if you answer me, then we can go forward. What is mentioned about A? A says that it is unlikely and low impact. Unlikely that it would occur, unlikely or low probability, unlikely, and the impact is also low. So in that case, which one do we take? Probability is low and the impact is also low. Accept, that's right. Probability of such a thing happening is low and the impact is also low. Then, but whereas B says that there is a highly likely chance to occur and with high impact. So this is high. Okay. So if we remember this one about the framework, it becomes easy for us to explain that. So you will not just write one word, but then definitely you will explain it. Risk C. Why should you accept? Why should you avoid? I think you can elaborate on that and then write, because it's not just one line or one word answer. So you will be able to do that. You please do that. Then coming to risk C. Risk C was assessed as low probability but with a high potential impact and also arises from an activity that must not be discounted, although alternative arrangements for bearing the risks are possible. The activity giving rise to was recently introduced by YGT as a result of new product launch. Low probability but with a high potential impact, and also arises from an activity but that activity that must not be discounted, although alternative arrangements for bearing the risks are possible. So, what does that mean? Also arises from an activity that must not be discounted. What is that? Okay. So the probability is low and the impact is high. So if the probability is low and impact is high, okay. Probability is low and impact is high. What is the option? What is transfer? What is transfer? The chances of such an event happening is very low. It is not a very regularly happening event. The happening of this event is low, but when it happens, the impact is very high. In such cases, the risk can be transferred to a third party, which is ensuring themselves against that particular event. That is that is the response which has to be taken up. So here it talks about risk C has low probability but with a high potential impact. Fine. But when does it arise? It arises from an activity. It arises from an activity that must not be discontinued, although alternative arrangements for bearing the risks are possible. So this is it is not independent in nature. It is arising because of some other event, happening of some other event. So how to manage that? Arrangements are made, but here, because of the chance of happening is quite low, but whenever it happens, the impact is high, like natural disasters or accidents happening. See, the happening of such event is not um, very high, it is very low, but when that those things happen, the loss is quite high. Therefore, it is always advisable to go for insurance. So that's the response here in case of C. The activity giving rise to risk C was recently introduced by YGT as a result of new product launch. Okay. Risk D. Risk D was assessed as highly likely but with a low potential impact and arose as a result of a recent change in legislation. It cannot be insured against nor can it be outsourced. It is strategically important that the company continues to engage in the activity that gives rise to risk D, although not necessarily at the same level as is currently the case. What is the response? What do you think is the response? Respond. Give your response. reduce. That's right. Okay. Risk D was assessed as highly likely, but with a low potential impact. The chance of happening of such events is quite high, but whenever they happen, the impact is low potential impact, and arose as a result of a recent change in legislation. So here, because it cannot be transferred, so it's already mentioned that it cannot be insured, it cannot be transferred against, nor can it be outsourced. So they cannot avoid it, they cannot transfer it, so they just have to accept it. But because the chance of such a thing happening is quite high, all possible measures should be taken to reduce the risk. So risk reduction is the strategy which has to be adopted. That should be the response for this particular case. So here it says that it cannot be insured against, nor can it be outsourced. It is strategically important that the company continues to engage in the activity that gives rise to risk D. So they cannot avoid it, they have to accept it. But when they are accepting, all possible measures to, because the impact though it is low, the chance of such a thing happening is quite high. So take all possible measures to reduce the amount of risk which is present. Okay. That is from A to D. After that, then we have that's for 6 marks. So using the TARA framework, select and explain appropriate strategy for managing each risk. So each one of them from the framework, we've selected one response. Third bit, explain what related risks are and describe how risk E and F might be positively correlated. 5 marks. What is it about risk E and F? In addition, risk E and F were identified. Risk E was an environmental risk, and risk F was classed as a reputation risk. What is environmental risk? We learned about the classification of risk. Any one of you, what is environmental risk?
Uh, Environmental risk can be defined as a actual potential threat of adverse effect on living organisms.
Sorry, but voice was breaking. I was not able to get your point. Good that you have responded. Please repeat it once again.
Ma'am, can you hear me now?
I didn't get you. Can
Ma'am, can you hear me?
now I am able to. Yeah.
Ma'am, it is nothing but actual or potential threat of adverse effect in living organisms.
Okay.
And that's it.
Okay. So here the slide which says environmental risk is the risk that arises from changes in the environment, such as climate change or natural disasters. Fine. Some businesses may perceive this risk to be low, but for others, it can be more significant. Insurance companies have to take environmental risks into account when deciding policy premiums and other things. So risk E is an environmental risk. Risk F is a reputation risk. So we've also discussed about what is reputation risk. So what's reputation risk? The risk that the reputation of the business would get affected is reputation risk. Okay. Reputation risk talks about the image of the business gets affected or the reputation of the business gets affected. So that's the reputation risk. Fine. The risk consultant said that risk E and F could be risk E and F could be related risk. So what is related risk? Related is if one risk happens, the other one also happens. So that is related risk. So they opine that these risks E and F could be related risk. In the formal feedback to the board of YGT, the consultant said that the company had to develop a culture of risk awareness and this should permeate all levels of the company. So what are related risks? So now we have to answer this part of it. We've understood what is the meaning of environmental risk and what is the meaning of reputation risk. But then here we have to talk about what are related risks. That's important here. They are not independent in nature. So if one thing happens, the other one also another one also follows. So they are related. So they do not happen independently, but the happening of one event will also will also result or causes the other event to happen. So they are related. Now, in that case, when they are related, here in environmental risk and reputation risk are correlated. Is the point? How do you think that? What are positively correlated? What are negatively correlated? What is no correlation? When there is no relationship between two variables, here the two variables are risk E and risk F are two variables. When there is no relationship, then they are independent in nature. So they are not connected. Each one of them may arise absolutely with no connection with the other one. So that is no relation. The relation they are related is what is the opinion. So now they are explain what related risks are. So the happening of one risk will result in the happening of another risk is related risk. So that is how we explain that. So we are talking about how they are related and what is the correlation between them. The correlation could be positive correlation, negative correlation. So here they are asking us to explain that and describe how risk E and F might be positively correlated. What do you think is a positive correlation? Positive correlation is something wherein when one what is positive correlation? They both move in the same direction, isn't it? You remember that positive correlation, negative correlation, statistics. What happened? No response at all. Do you think that both of them are positively correlated? Environmental risk is the risk which the risk which arises from the changes in environment. And whenever it is about the environmental issues, there are certain rules which are laid down by the government which have to be complied with. If there is any impact which is caused on the environment because of the business, then they are causing some impact on the environment. To protect against that, the government lays down certain rules and regulations for the business entities. So they have to also follow those rules and regulations. They have to comply with the rules and regulations. So compliance is a situation which arises in case where there is an impact on the environment. Compliance, fine. Now they are immediately connecting this environmental risk to reputational risk. If they do not comply with that, if they do not comply with that, then their reputation also gets affected. Are they positively correlated? How will you explain that? What is positive correlation? In the first point, we have to understand what is positive correlation. Any one of you, what is positive correlation? They both move in the same direction. Since it is, we are talking about risk, if one risk is less, the other risk is also less. If environmental risk is less, when will environmental risk be less? When they comply with all the rules and regulations, when they follow all what is prescribed for that entity, they follow that and then see that there is less impact on the environment. In such a case, their environmental risk is low. When the environmental risk is low, the reputation risk also will be low. If that is not the case, if environmental risk is low and if the reputation risk rises, then we call it as negatively correlated. But that is not the situation. It is a positive correlation. Both of them are moving in the same direction. See, if their environmental risk increases, that is, they do not comply with the rules and regulations, the risk rises. When that risk rises, their reputation risk also will rise. So both of them will move in when both of them move in the same direction, we call it as positively correlated. I hope it is clear now. So because they are explaining, they are identifying them to be as positively correlated, they are related risk. Definitely if they do not comply with the rules and regulation, their reputation gets affected. They are correlated, they are related risk, and they are positively correlated also can be explained. The risk consultant said that risk E and F could be related risk. In the formal feedback to the board of YGT, the consultant said that the company had to develop a culture of risk awareness, and this should permeate all levels of the company. Okay, I hope this is clear. Is this clear? No response at all. Am I audible? Okay. Um, let's get back to the PPT. See, they're almost all the topics are overlapping in your syllabus, since you have learned so many things from various topics, and whatever was there except the financial risk part of it, we have covered all of them. um, I have taken you through the corporate social responsibility also. Did we do corporate social responsibility? Did we do corporate social responsibility? Let's quickly go through what is corporate social responsibility and take up one case related to corporate social responsibility from SPL examination kit. Okay. What is CSR, corporate social responsibility? Is an approach to business that considers all stakeholders and provides economic, social, environmental benefits along with sustainable growth for the organization. So this is an argument which says that, okay, the business has some responsibility towards the society. That is the argument of CSR. CSR talks about that the business has some responsibility towards the society, towards its stakeholders for their benefit. It has to take up certain activities, okay, which will benefit the society. It considers all stakeholders and provides economic, social, environmental benefits along with sustainable growth for the organization. Fine. What are the benefits of that? Benefits of CSR, or the corporate social responsibility, talks about the differentiation, attracts and retains high caliber staff, cost reductions, new opportunities, increased profitability. We have discussed all these things. I do not know whether, because the same students are not present across, maybe you were not present there, but then these are the benefits. The benefits are um, differentiation. Those organizations are identified as um, someone who are they're in the business with the purpose of they work towards a specific cause. We see certain products, they also advertise that a part of the price, the selling price, goes towards a social cause. So the customers get attracted, the customers get I mean, they feel motivated to buy such products because the price, a part of it, is used for some benefit of some group in the society. So um, that is one way they can differentiate themselves from others. Some of the organizations, even in India also, we see that they are not established solely with a profit maximization motive. Yes, they are there to earn the profits, but they also present themselves, they also work within a motive of providing quality products and services to the customers, to various stakeholders in the society. So they differentiate themselves from others. That's one thing. Second is attracts and retains high caliber staff. So some organizations, so even the pay packages are less also because of the value system which is prevailing in those organizations. Employees want to be associated with such organizations. So it becomes easy to attract high caliber staff in such situations. Then cost savings, reduced fines, less packaging, energy usage. So when they are working towards the benefit of the society, so they are fined less. Um, they are I mean, they do not have to face that. Just now in the previous case we were discussing about environmental risk and reputational risk, so one is connected with another one. So when they have less impact on the eh, I mean environment, then their reputation is not also not affected. So also when somebody is involved here, providing some benefit to the society, in that case they will be looked at as someone working for the benefit of the society, and their fines also will be reduced because they would be going with the compliance part of it. So they are doing some work for the benefit of the society. So less fines, reduced fines, less packaging, energy usage. So they do not have to attract the customers with the high cost of packaging and all. So energy usage also would be less. So all these reasons will result in saving on the cost savings. Then there may be new opportunities arising for them, and increased profitability as a result of all the above. Though they do not work within motive of maximizing profit, yet it can result in maximization of profit in another way, wherein the demand for their products can increase, more customers can get attracted to the way they are doing business, and therefore the profit can increase. Profit increases because of the increase in the volume of the products. It is not because of the high profit margin. This is the number of units sold are more in number. Therefore, the profit margins are high, increased profitabilities. It is not because adding a high profit margin that their profits are high. There are risks also which are associated with that. See, the first argument about it is, see, when an entity is established with an intention to maximize their profit, um, spending high cost will result in a decrease in profit, and that will not allow them to maximize their profit when they are incurring cost for not for the benefit of the organization, but for the benefit of the society. If that is the case, um, the argument is that why take up any activity which is not resulting in profit maximization. The very basic purpose is to satisfy the shareholders. Wealth maximization is the objective with which they are established. So why deviate from that objective and spend costs on certain things which do not um, help them to save costs, and it has an impact on wealth maximization. So that is the argument against the concept of corporate social responsibility. So the risks which are associated with corporate social responsibility, the first one is agency risk. Directors choose the CSR aspects they like rather than the owners of the organization. When a company is established company, the investment is made by the shareholders, the owners. Okay, but owners or shareholders do not run the business. They do not manage the day to day efforts of the company. Who manage that? The um, the managers, the directors who are appointed there, they run the business. So there is a agent owner and agent relationship here present. So the ones who own the company, the shareholders, the investors, they do not run the business, but the decisions of the business day-to-day activities are run by the managers or the directors of the organization. So they are acting as agents to the owners. So there is an agent owner relationship here. So agency risk is, what is the first thing. Now the owners, what they want may not be applied here by the managers, by the directors. They may not run the business the way the owners want it to be run. So here the first risk is what the owners want the company to take up, that may not be taken up by the directors. So that's the first risk. Fine. Second one says that loss of focus on primary aim. What is the primary aim? The primary aim is to maximize their profit. So in between, if they are deviating from their main objective, so the focus is lost. So that's another risk, which is sometimes they spend too much on CSR, and not focus on efficiency, effectiveness, cost reduction. Those things they may not focus on that. So there is a loss of focus on primary aims. Then it says that spends too much. If they to take up those activities, if they are spending a lot on CSR, then that will result in decrease in their profit. So those are the risks which are present with the CSR. I'll take you through one case which is given in SBL. Just 1 second. Okay, here we'll go through the case. The question says that explain the importance of sound corporate governance by assessing the consequences of the corporate governance failures at ZPT. Construct the case for the mandatory external reporting of internal financial controls and risks. Explain the board areas that the proposed external report on internal control should include, drawing on the case content as appropriate. So here we have, this is a 24 marks case. Here we touch through the corporate governance issues. Then there is something related to the reporting part of it, and then the internal financial controls and risks, and other aspects about the internal control. So it's not only one particular topic, but there are multiple issues here. We'll read through the case and then try to answer this particular question. In the 20X9 results presentation to analysts, the chief executive of ZPT, a global internet communications company, announced an excellent set of results to the waiting audience. Chief Executive Clive XQ announced that compared to 2008, sales had increased by 50%, profits by 100%, and total assets by 80%. The dividend was to be doubled from the previous year. He also announced that based on their outstanding performance, the executive directors would be paid large bonuses in line with their contracts. His own bonus as chief executive would be 20 million. When one of the analysts asked if the bonus was excessive, Mr. XU reminded the audience that the share price had risen 45% over the course of the year because of his efforts in skillfully guiding the company. He said that he expected the share price to rise further on the results announcement, which it duly did. Because the results exceeded market expectation, the share price rose another 25% to $52. 3 months later, Clive Zhu called a press conference to announce a restatement of the 20X9 results. This was necessary, he said, because of some regrettable accounting errors. Regrettable accounting errors. This followed a meeting between ZPT and legal authorities who were investigating a possible fraud at ZPT. He disclosed that, in fact, the figures for 2009 were increases of 10% for sales, 20% for profits, and 15% for total assets, which were all significantly below market expectations. The proposed dividend would now only be a modest 10% more than the last year. He said that he expected a market reaction to the restatement but hoped that it would only be a short term effect. The first questioner from the audience asked why the auditor had not spotted and corrected the fundamental accounting errors, and the second questioner asked whether such a disparity between initial and restated results was due to fraud rather than accounting errors. When a journalist asked Clivesew if he intended to pay back the 20 million bonus that had been based on the previous results, Mr. Zhu said he did not. The share price fell dramatically upon the restatement announcement, and because ZPT was such a large company, it made headlines in the business pages in many countries. Later that month, the company announced that following an internal investigation, there would be further restatements, all dramatically downwards, for the years 2000, 20x6 and 20x7. This caused another mass selling of ZPT shares, resulting in a final share value the following day of $1. This represented a loss of shareholder value of $12 billion from the peak share price. Clivesew resigned, and the government regulator for the business ordered an investigation into what had happened at ZPT. The shares were suspended by the stock exchange. A month later, having failed to gain protection from its creditors in the courts, ZPT was declared bankrupt. Nothing was paid out to shareholders, while um, suppliers received a fraction of the amounts due to them. Some non-current assets were acquired by competitors, but all of ZPT's 54,000 employees lost their jobs, mostly with little or no termination payment. Because the ZPT employees' pension fund was not protected from creditors, the value of that was also severely reduced to pay debts, which meant that employees with many years of service would have a greatly reduced pension to rely on in old age. The government investigation found that ZPT had been maintaining false accounting records for several years. This was done by developing an overly complicated company structure that contained a network of international branches and a business model that was difficult to understand. Whereas ZPT had begun as a simple telecommunications company, Clivesew had increased the complexity of the company so that he could hide losses and misreport profits. In the company's reporting, he also substantially overestimated the value of future customer supply contracts. The investigation also found a number of significant internal control deficiencies, including no effective management oversight of the external reporting processes and a disregard of the relevant accounting standards. In addition to Mr. Xu, several other directors were complicit in the activities, although Shazia Low, a senior qualified accountant working for the financial director, had been unhappy about the situation for some time. She, ha- she had approached the finance director with her concerns, but having failed to get the answers she felt she needed, had um, threatened to tell the press that future customer supply contract values had been intentionally and materially overstated. The change in fair value would have had a profit impact. When her threat came to the attention of the board, she was intimidated in the hope that she would keep quiet. She finally accepted a large personal bonus in exchange for her silence in late 2008. as she needed the funds for her ill mother's medical bills. The investigation later found that Shazia Low had been continually instructed against her judgment to report figures she knew to be grossly optimistic. The investigation found that the auditor JJC Partnership, one of the largest in the country, had its independence compromised by a large audit fee, but also through receiving consultancy income from ZPT worth several times the audit fee. Because ZPT was such an important client for JJC, it had many resources and jobs entirely committed to the ZPT account. JJC it was found knowingly signed off inaccurate accounts in order to protect the management of ZPT. And this own senior partners engaged with the ZPT account. After the investigation, JJC's other clients gradually changed auditor, not wanting to be seen to have any connection with JJC. Accordingly, JJC's audit business had since closed down. This caused significant disturbance and upheaval in the audit industry. Sometime later, Mr. Zhu argued that one of the reasons for the development of the complex ZPT business model was that it was thought to be necessary to manage that many risks that ZPT faced in its complex and turbulent business environment. He said that a multiplicity of overseas offices was necessary to address exchange rate risk, a belief challenged by some observers who said it was just to enable that the ZPT board to make their internal controls and risk management less transparent. The ZPT case came to the attention of Robert Ney, a senior national legislator in the country where ZPT had its head office. The country did not have any statutory corporate governance legislation, and Mr. Ney was furious at the ZPT situation because many of his voters had been badly financially affected by it. He believed that legislation was needed to ensure that a similar situation could not happen again. Mr. Nai intends to make a brief speech in the National Legislative Assembly and has asked for your help as an external consultant to outline the case for his proposed legislation and draft some of its proposed provisions. Very big case. The first one is completely on corporate governance and the risks which arise on account of bad corporate governance. So, explain the importance of sound corporate governance by assessing the consequences of the corporate governance failures at ZPT. So, first we need to identify what are the areas in which ZPT failed. A very big one, we see that there was a drastic thing which happened, that they went bankrupt, right? The organization had to discontinue its operations, and to the extent that they were not able to pay the minimum things also to its various stakeholders because the debts were so high. They went bankrupt, and their employees are also were not protected. Why did ZPT fail? Is first let's identify. If we identify that, then we can talk about what are the what is the importance of having a sound corporate governance, and what happened in ZPT that such a risky situation arose. The first paragraph talks about the performance reports of the organization ZPT, and somebody was paid a huge bonus because of the the performance in the stock market was beyond what was expected, and that has resulted in the increase in the share prices. Big on account of that, somebody was paid a bonus. Okay, who was paid? So what is that called as? One second. So what is this called as? Someone, I mean, they have announced the results, and the results were so good, um, that resulted in an impact on the share price. The share price, again, first it rose by 45%. Then later on, another 25% increase was seen, and the share price now stands at 52 $52. The other part of it is the dividend was to be doubled from the previous year. He also announced that based on their outstanding performance, the executive directors would be paid large bonuses in line with their contracts. His own bonus as chief executive would be 20 million. Then later on, it was identified that 3 months later, Clive Zhu called a press conference to announce a restatement of the 2009 results. This was necessary, he said, because of some regrettable accounting errors. Now, that has resulted. Okay, then this followed a meeting between ZPT and legal authorities who were investigating a possible fraud at ZPT. Done. Then he disclosed that in fact the figures for 2009 were increases of 10% for sales, 24% for profit, and 15% for total assets. Earlier, when they have announced it, these figures were so different. How did they announce these figures to be as? Okay, so they have announced that sales had increased by 50%, whereas actually the increase in sales was only 10%. They have announced that sales had increased by 50%, but whereas when we look into 10% for sales, then they have mentioned that their profits increased by 100%. In fact, actually profits were only by 20%. Then they said the total assets have increased by 80%, whereas there was an increase of only 15% for total assets. Okay, so which were all significantly below market expectation. So what did they do? They have manipulated the figures. They have projected their financial position to be much above the expectation of the investors. So they have manipulated, they have involved in misrepresentation, misleading information of the accounting information. So that they have projected as a very high rise in sales, profit, and the total assets. That that caused some impact on the share price. Share price drastically rose to 52. Why did they do that? What was the reason? Because they are entitled to receiving a bonus. This is called as dysfunctional behavior. Dysfunctional behavior. Their personal benefit is what they are focusing on. They are only looking at what is their benefit. Okay, we've understood about what is corporate. Okay, continuing with the CSR part of it. What is corporate governance? Governing the organization, the agent relationship. Okay, what is a corporate governance? Um, the system by which companies are directed and controlled in the interest of shareholders and other stakeholders. Then it talks about what is the importance of corporate governance. Then what are the limitations of corporate governance? So let's to answer this, let's quickly go through what is corporate governance, because we've already done about these things. Let's look into this. The system by which companies are directed and controlled in the interest of shareholders and other stakeholders. Um, because there is an agency relationship, the company, the owners, and the directors. So when the directors are running the business, their intention should be to maximize the profit of the owners. But if they do not take up their activities, which can benefit the owners, but if their personal benefit is taken care of, or their intention is to be benefited personally, then they are not maintaining that agency relationship properly. They are more focused on looking at their personal benefit. So here it talks about the corporate governance part of it, talks about um, the system by which companies are directed and controlled in the interest of shareholders and other stakeholders. So they have to look at the shareholders profit maximization, the employees benefit who are employed in the organization, the suppliers, their when they provide credit facility, their due amount should be paid on the due date. The customers also should not be charged with high prices, because they are supposed to take measures to cut down on the cost, control the cost. So in the benefit of the shareholders and the other stakeholders, they have to run the organization. Fine. While running this organization, there is also a possibility that they may overlook the interest of the various stakeholders, they may look at their personal benefit. That is what actually happened in this particular case also, the one which we have discussed just now. So the importance of corporate governance is, in most countries, listed companies are required to comply. It is often built into stock exchange listing rules. It seeks to prevent fat cat salaries, plundering of the company pension funds, and other unethical behavior. All these things is mentioned in this particular case, and then we have looked through that. Okay, we've looked at that the directors were entitled to some bonus if the profitability position is projected well. So here they also have claimed that bonus. The directors who are working there in this particular organization also have claimed bonus, projecting the financial results to be very high. Okay, increase in sales, increase in profit, increase in assets, all of them were projected as very high on a relative term, comparing 2009 results with 2008 results, and that has caused some mm, uh, I mean impact in the stock market, and the share prices of that particular company have risen drastically. After all this was projected, then they have claimed the bonus also. So bonus also was paid to the directors. Later on, after a while, they have come out with an announcement that there are certain accounting errors, and they have corrected their figures and disclosed their figures of sales, profits, and assets, which are drastically very low, below the expectation of the various stakeholders in the market. Okay, so here, to see that such a thing does not happen, the rules what have to be followed, how the organizations have to be governed, run, managed by the directors or the managers of the organization, that has to be listed down, is also what has to be looked into. But in spite of that also, we see that directors work in such a way that they can be benefited on a personal note. So the personal benefit is always looked at. Okay. Uh, what are the limitations of corporate governance? It does not prevent company failure or collapse. In spite of having all these rules and regulations, also, it is not possible to prevent these failures, company failures, from happening. It cannot prevent companies failing to achieve their objectives. So these are the limitations. So that is what we have looked into. Okay, in relation to internal controls, the board is responsible for maintaining a sound system of internal control. Um, the roles and responsibilities are mentioned. Okay, so to see that such a thing, that the directors and the managers um, run the business effectively, and do not involve in anything which can result in a misrepresentation, misleading of information, or involve themselves in any fraud happening. We have this internal controls. We've discussed about internal controls and the other issues with the internal controls also. So the rules which are there, Sarbanes-Oxley Act, then okay, SOX thing, we have learned about that. Then we have learned about the COSO framework, all of them. So why are these things needed? These things are needed to ensure that there is a sound internal control system in the organization, which can prevent these misrepresentation of information, misrepresentation of information, or frauds happening from the in the organization. They can ensure that there is effectiveness, efficiency in the organization, reviewing the effectiveness of internal control, reporting to shareholders that this review has been carried out. Okay. Um, if that is not the case, okay, then there is a possibility that the organizations fail. That is what exactly happened in ZPT also. So ZPT later on, the Clive Zhu has called for a press conference later on and mentioned that there were some regrettable accounting errors. And this followed a meeting between ZPT and the legal authorities who were investigating a possible fraud at ZPT. And he disclosed what are the real facts he disclosed. The proposed dividend would now only be a modest 10% more than last year. Okay, but then what did they do with the dividend part of it? Dividend, the dividend was to be doubled from. In fact, when it was to be only a 10% rise, they have increased it by 100%. The dividend was doubled from the previous period. So that was another mistake what they have made. Fine. Now there was an investigation. The first questioner from the audience asked why the auditors had not stopped. There again, we have looked into that. The company JJC was, I mean, involved in getting personally benefited because ZPT was a very big client, large client, and a major part of their revenue was coming from ZPT. Many accounts were connected to ZPT. Therefore, they also did not want to disclose what was actually happening in ZPT. Someone also raised the issue, okay, but that person also was silenced because she needed some money for her mother's ill mother's medical bill. So, in addition, Mr. Zhu, his mother's medical, Mr. Zhu, several other directors were complicit in the activities. All this Shazia Lo, no, Shazia Lo, lady only, Shazia Lo, a senior qualified accountant. She was also made to keep quiet about the fraud which was happening, the accounting misrepresentation which was happening, because she was also kind of bribed here. Okay, a huge amount, a huge personal bonus was paid to her, and then therefore she did not reveal those things. So here in this case, all this has resulted in a very drastic thing happening at ZPT, wherein ZPT had to go for bankruptcy. Okay, insolvency and bankruptcy. Therefore, now we have to identify here. We are asked to draft the speech for Mr. Nay to cover the following areas. Um, the ZPT case came to the attention of Robert Nain, a senior national legislator in the country where ZPT had its head office. The country did not have any statutory corporate governance legislation, and Mr. Nain was furious at the ZPT situation because many of his voters had been badly financially affected by it. Okay, so now to help Mr. Nay address this particular issue, we are asked to draft the speech. Okay, I hope you know what you are supposed to do. So first we need to talk about what is the importance having a um, sound corporate governance. So that is what we have to address here now. Anyone has any point? Start like a speech only. The questions are asked in different ways. Write a report. Just talk about state questions, like explain the importance of something like that. So you do not have to do it in a particular fashion. But if suppose if you are asked to write a report to or addressing to someone, so you have to address that to that person, to the director, to something like that, and then you have to start talking about your what is the subject line of that. All those things have to mention. Here it is a speech. Speech is how would Mr. Nay start talking about these things? So the formal way of addressing. So maybe you can start about addressing as ladies and gentlemen, or something like the good evening audience present over here, or something like that. You should start and then write, and then talk about what is the importance of sound corporate governance. So what's the importance of sound corporate governance? Each one of you, I think seven are there, 7 or 6 are there. So you can 7 students are there. Each one of you, even if you present one point also, we can gather 6 to 7 points easily. So please add one point. Either you talk on the mic or write it. What is the importance of having sound corporate governance? And then the question is saying that by assessing the consequence of the corporate governance failures at ZPT. So it is a failure. We have looked into that part of it. We've understood that it is a drastic failure. So if it is a failure, if such a thing not to happen, there should be sound corporate governance. So what is the importance of sound corporate governance? Any one of you, please start. When there is sound corporate governance, what happens? Such a drastic thing of organization failing will not happen. Corporate failure will not happen, isn't it? Anyone listening to me, or only I am talking on the mic? I think I am talking. No one's listening to me. Not interested to do case studies. If you're not interested to do, then I will also not do, because see, it is not explaining some concept. It is about discussing with the students about what could be the possible answers. If that is the case, then coming 1 2 classes, we'll finish up whatever are the remaining topics which are left, and then officially close this particular class. Please respond. Any 1 point. If not each 1 point, all of you together 1 point. Corporate failures can be stopped is 1 point. Not interested? Any one of you? Am I audible? First thing, I have my doubt. Okay. Increase accountability, increases transparency. Very good, excellent. Okay. Increases accountability, transparency. Then anything else? The major thing which of the failure of the corporation that is there. Then here, because this has to be connected to the failure at ZPT. So ZPT, we have seen that the stakeholders also got affected. Stakeholders, the creditors were not paid their due amount. The employees, 54,000 something was the number. All of them have lost their jobs. Then the pension fund is a very important aspect in case of mm, other countries. They are protected with some pension fund. So even if they lose their job, also some amount which gets accumulated in the pension account, also pension benefits, pension plans and all are there to protect the employees. Here in this case, we see that that was also not protected. Okay, a major part of the savings of the employees in the form of pension fund was used to pay the amount of the creditors. In spite of that, the creditors were not completely paid off. So for the benefit of various stakeholders like creditors, customers, employees, all these things for their benefit, this is important that there is sound corporate governance in an organization. Okay, so transparency, it increases transparency, yes. To avoid everything being transparent, then they have what did they do? They have adopted a complex and turbulent business environment. They had a multiplicity of overseas offices. So when the offices were established in other countries, it was not possible to look into what are the activities of the organization. Okay, for that reason. Then accountability part of it also. What are the decisions of the directors also can be known. For that reason, yes, increase accountability and transparency. So anything else, if you can think about, please add it later on also. Okay, now here we see that ZPT is a failure. So to see that such things do not happen, it is important that there should be sound corporate governance. 10 marks out of 24. Roughly about 35 to 40% of marks are allotted only for the first one, 10 marks out of 24. Fine. Then B talks about construct the case for the mandatory external reporting of the internal financial controls and risks. So it is touching on the topics of internal control. So let's quickly go to the PPT and then look at the internal controls aspect. So internal control system, when there is an internal control system, it helps from accounting frauds happening, misrepresentation, misleading information being included. It prevents from all those things. So what can internal control system do and help the organization in it helps in running the business effectively, efficiently, safeguarding the assets and adherence to management policies, prevention and detection of fraud and error, and the as far as possible the completeness and accuracy of the records. Fine. um, Here we see what is the role of roles and responsibilities in risk management and internal control. We see that these are the roles and responsibilities of various people in the organization: CEO, board of directors, risk committee, and executive management, internal auditors, head of business units, all employees, external. So when such a thing happens, everybody takes care of that. Um, the internal control system which is uh, installed in an organization has to be reviewed by the internal audit committee. They look into that. The officers who are appointed to review the internal control system also ensure that it is adequate to have effective internal control system in the organization. They have to review that and prepare a report and duly sign that report. Okay, that is one requirement in case of internal control system. So here it says that construct the case for the mandatory external reporting of internal financial controls and risks. So the internal control system very specifically with the financial controls about how the accounting information is presented. So that is the financial control system. So along with the financial reporting, their report on the internal control system also has to be prepared, integrated with the financial statements, and that has to be disclosed. So that is one requirement under, okay, PCAOB. We don't have that act here. uh, the audit standards, under the audit standard number 5 talks about integrating the report prepared on the internal control system, integrate that with the financial statements and disclose them or report them, use for external reporting. So when the external financial statements are reported, along with that, another report on audit of the internal control system, review of the internal control system, a report has to be prepared and integrated with that. So here we need to talk about that. When they have an internal control system, okay, the report has to testify that the internal control system is efficient enough to control the fraud happening. So that has to be, if it cannot detect the frauds and errors from happening, then there should be some changes made to the internal control system, and a report has to be prepared on that. So that is the importance what is talked about here in point B. It says that construct the case for the mandatory external reporting of internal financial controls and risks. So talk about that and then explain in detail about that. Then we see explain the broad areas that the proposed external report on internal controls should include, drawing on the case content as appropriate. Okay, broad areas that the proposed external report on internal control should include. So what do you think should include? This is again is referring to the case what is there. We have to talk about what should be included in the external report. What should it include? Talk about what is the role and responsibility of each of them. um, um, I mean, all that has to be attested. They have to duly sign. So highlight about who are the people who are involved in implementing an internal control system. What is their role and responsibility? So that has to be reviewed. Okay, that can be included in the external reporting. So the accountability comes into picture. When the accountability comes into picture, then they would not be involved in any fraud happening in the organization. See, that accountability was missing there. So each one was looking at their personal benefit. The accountant was looking at her personal benefit. The audit company also was looking at their benefit. The firm was looking at their benefit because the major part of their revenue comes from ZPT. Okay, so here internally, externally, whoever are involved in ensuring that the internal control system are effectively implemented, they have not um, taken up their responsibility appropriately. So if there is some involvement of, if they are made accountable, if they attest to whatever is the work they have done, so that if it is included in the external financial reporting along with the financial statements, if these things are also included, integrated with the financial statements, then there would be a possibility of um, preventing such frauds happening. So that is a 6 marks question. Now the question here starts as write a speech. So everything should be connected. It should be in the form of a speech, as if you are talking, giving the speech. So when you start with good evening, ladies and gentlemen, from that note, no question should go in a different thing. Yes, you can write the side headings, When you talk about sound corporate governance, you talk about consequences of a failure of corporate governance and ZPT. So when you talk about that, you can have side headings mentioned there. But then later on, when you go to the mandatory external financial reporting and the proposed external report, all of them should be connected. It should go in a flow and then conclude it as you would conclude a speech. Okay, so this is 24 marks question, covering about the corporate governance, their role, responsibility, internal control, reporting of the financial statements. All these things are connected in one particular case, and answer that. Okay. I will have a word with Sudesh sir about what are the financial risks which were covered. I'll have a word with him, and then tomorrow also we have a class at 12 o'clock, 12 to 2 p.m. If possible, we will start on that. So we'll finish the syllabus first. Most of the topics we've already discussed. If time is available, then we will look into cases. Otherwise, I will just finish the syllabus and you can only do the cases. Um, Okay, so I'll see you tomorrow in the afternoon at 12 p.m. So all what is left in the syllabus is from related to the financial aspects of financial risk. But I was advised that I first find out from Sudesh sir, because he's the one um, who's done this particular topic for you in AFM paper. So that is what is the information I have. So accordingly, we'll take it up and then finish the syllabus. Okay. Okay then. Good day.